Hello everyone, welcome back to our channel. Today we are going to break down some key factors that influence the pricing of Nifty call and put options. Not only Nifty, stock futures and other indexes. We will also look at how to calculate the intrinsic value of these options. Before diving to the video, last week I upload for how to identify in the money, at the money, out of the money. If you are not watch, I'll make a link in the description. You can watch this video for continuous version for that video. Let's dive in. In this slide, we look about extrinsic premium factor. What is the extrinsic? Motivational came from external rewards. This is not the original definition. It's make myself for easy to understand. Let's understand with one example. You bought 100 kg rice, 100 rupees. You sell it next month, 100 kg rice, 55 rupees. Due to demand and supply. If demand rise, price will go high. If supply high, price will go down. Some key factor which is important, time decay. Coming slide, I will explain more. Next, intrinsic value. Motivational came from internal desires. Let's look about one example. Same one person, we purchase 50 kg rice, 100 rupees. We sell it 50 kg rice, 120 rupees. So immediately we got profit. Difference between extrinsic value and intrinsic value. First one, look about delta. What is delta? Delta measure the change in the option price for 1 rupee. Change in the underlying asset price. Asset price is the Nifty or stock futures or other index. For one example, if Nifty call option has delta of 0.5 and Nifty move up by 1 rupee, what will happen? Option premium price will increase by 0.5. So delta drive the option premium, right? Second, gamma. Gamma measure rate of change of delta. Rate of change of delta for 1 rupee. Change in the underlying asset price. If gamma 0.5, again Nifty move up by 1 rupee. Of course, delta will increase 0.5. So gamma drive to delta. Delta drive to option premium. Third one, theta. Theta measure change in the option price with respect to time decay. This is the important one, time decay. One example, if Nifty call option has theta of minus 0.05, option price will decrease by 0.05 each day. On Friday, end of the trading section, 3 o'clock, we assume Monday there is gap up. So we'll take entry in the Friday, end of the section, 3 o'clock. We expect to the gap up on the Monday. But what happened? Nifty, same thing happened, gap up 20 points. But option premium not increase due to time decay. Because each day there is price will decrease by 0.05 paise. Fourth one, Vega. Vega measure the change in the option price with respect to change in volatility. Same, we take PDST trade. PDST means buy today, sell tomorrow. Same Friday we take entry. We assume gap up, there is gap up in the Monday, we sell it. In Monday what happened? There is huge gap up due to news factors. That time Nifty put option has Vega of 0.2 and the volatility increased by 1%. Of course, option premium will increase by 0.2. At last one, row. Row measure the change in the option price with respect to change in the risk-free interest rate. Example, if Nifty or Bank Nifty call option, any or Reliance, we know Reliance, call option has row of 0.1 and the risk-free rate increased by 1% and finally premium price 0.1. That's it for eccentric premium factors. We look about intrinsic value. For intrinsic value there is no definition, only formula. Different formula for call option and put option. First we look about call option. Intrinsic value IV equal to spot price minus strike price. Example, Nifty spot price currently 24,750. ITM in the money option 24,300. Premium value 530 and IV 450. How come 450? So spot price 24,750 minus strike price 24,300. For eccentric value IV minus premium, right? And the same for ATM, OTM. Similar for the ATM and OTM. Second, put option. Intrinsic value equal to strike price minus spot price. And as we know, in the money for put option 25,300 and in Nifty spot price 24,750. So strike in the money minus by spot price. IV intrinsic value 550, for eccentric value IV minus premium, so 50. Similar for the ATM and OTM. For this slide, we can observe 3 points. First one, in the money, IV is high value. Second is OTM, there is no IV, 0. Expiry, on the expiry, 0, completely 0. At the money, eccentric value, high value, right? If you are buyer, we have to choose in the money option due to intrinsic value is high. Even though expiry, it will not go to the 0 value. If we are seller, we have to look about eccentric value. Therefore, you will get entire profit. While intrinsic value 0, eccentric value is high. So that time you will get the good profit in the seller side. We will entire get the premium 205 for the call option, 205 entire premium we will collect for the seller. At end of the slide, where we will get this kind of data, log in our broker or either sensible option chain. There is option chain. You can find out Greek view. You will get the entire data for gamma, Vega, Theta, Delta. Under row, nobody look about this one. I hope this explanation help you understand the key factor that influence the pricing of Nifty options and how to calculate their intrinsic value. That's it. Thank you for watching. Thank you so much. We will meet next another video. Thank you for watching. Thank you.